Alright, good afternoon, everybody. What's going on? Happy Monday, October 2nd. What's up? Good seeing you guys. Another crazy day. Crazy day. Alright, let's talk about it. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here is basically the same, except I added some XLU overnight. Contrary to what I said that I'm doing in the meeting, I'm trying to work positions down because I'm going on vacation in a week. I'm trying to spend this week working positions down, maybe taking some day trades here or there, but not really adding to swings. And here I am with a new swing. Not expecting to be in this one for more than a day or two. It's really meant to just be a trade. I also made some mistakes in it today, which I'm happy to talk about. Happy to talk about my mistakes. Let's figure out how we closed today. SPYs right now, we have a little bit of like a 20-cent uptick from the close. With that 20-cent uptick, we're actually starting to tick green on our day. But really, we closed down very small on the SPYs. It certainly didn't feel like it. It felt like a big down day today. Unless you're looking at a handful of stocks that were up a lot, in which case it looked like a big up day. We could talk about that in a second also. Qs here also upticking 20 cents after hours, but closing positive on the day, 0.8% or so. And the IWM was a bloodbath, ticking up 12 cents here after hours, and even with that, still down 1.5%. So the average stock that you looked at, unless you were looking at a few select tech names, this was not a good day for the stock market, and that can also be seen in the RSP. It's interesting, and we've seen that a lot this year. Like this year, last year, I guess, more than I ever really remember seeing, but maybe I didn't look at it as closely. The difference between the equal weighted S&P and the actual index. Because the actual index, again, including the 20-cent uptick here after hours, is flat on the day, and the RSP is down a full percentage point. That's a huge divergence between market cap weighted stocks and the average stock that's out there. And it was interesting because I guess Goldman had a note this morning that said that they think big cap tech is cheap and that's what you should buy up. It's the complete opposite of what we saw out of Subramanian from Bank of America, and I think one of the other sell-side analysts last week, I think it was UBS, but I'm not sure, who said the complete opposite. And the data that I've looked at also says the opposite, that big cap tech is actually expensive historically on most fundamental metrics, whereas the average stuff that's out there is getting relatively cheap. You know, I don't know. Tomato, tomato. Fundamentals, take them as you will. We know that the market can be irrational for longer than you can remain solvent, all that fun stuff. I've seen markets trade away from fundamentals for extreme periods of time. I'm not even going to try to make an argument on who's right, Goldman or Bank of America on that, but it seems like they're saying opposites. The one thing I would say in defense of the Goldman call is maybe they can both be right at the same time. Like I think on a lot of fundamental metrics, if you're just looking at like forward PE multiples and stuff like that, that big cap tech is expensive. But a point that I was driving last week, and I think Microsoft is a pretty good example of it, is that if you look at Microsoft's balance sheet, and I read something about it, I didn't do this research myself, and I can't exactly quote or remember off the top of my head where I read this, but I believe, and someone can fact check this, but this is what I was reading, Microsoft has more cash on their balance sheets than they have debt. And all of that debt, for the most part, was issued during this COVID period of time when interest rates were basically at zero. So, and I think it harkens back to a Warren Buffett quote that I also am recalling off the top of my head, where he has said, don't raise cash via debt when you need it, raise it when you can. And I think a lot of these smart CEOs and CFOs from these big companies, definitely Apple, that's the one that always stands out in my mind with that huge 40-year note that they raised at some insanely low interest rate during COVID. Um, Microsoft has debt issued at 3% interest rates. They have even more cash on their balance sheet than they do debt, and they're bringing in probably 5-6% on their cash. It's an insane spread. So if you've got all these worries about whatever interest rates or the market or whatever, these companies they're just safe havens. So it's like, yeah, maybe they're trading a little bit expensive, but they're probably trading expensive for a reason. They're cash machines. They're making more and more money, and as they make more and more money, they're able to get a great return on it now. They're able to get a great return on their money. And this is what we also were talking about in an afternoon meeting a little bit last week, about how I think the Fed really needs to stop. The Fed obviously started hiking too late in the cycle. We all know that. But for the most part, I've been giving the Fed a lot of credit on how they've stayed the course, and they've really tried to work interest rates down, and they followed through with everything that they were saying that they were going to follow through. But I think it's starting to hit the point here where they need to stop, because they're missing the mark. They're creating some real haves and have-nots. Microsoft being a have, but you could also look at individuals that are out there. Who are you hurting that's bringing inflation down? Because if anything, increasing interest rates at a certain point might almost have an inflationary effect in some regards. If you look at not only companies like Microsoft, but you look at very wealthy individuals out there who were borrowing at 3%. Again, I've got a mortgage at like 3%, and they have jobs and they're making money, and now they're getting 5-6% return on their cash, and they're getting real returns on it. Like for a lot of people who are like that, you probably just want interest rates to go higher. You don't need to borrow money, and you're going to keep getting a greater and greater return. And how does that help to bring inflation down? It doesn't. It's just the have-nots out there, the people who didn't get the opportunity to buy a place during COVID, or they're just coming into their income earning years and they're at a point where they need debt in their life. All right, those people are just, it's a terrible time to probably be a young person in your 20s trying to figure life out and do household formation and all that stuff. So I don't know, they absolutely need to stop, and the market, I think, is signaling it too, just with the way the TLT is moving, the way that XLU is moving. It's getting pretty crazy. So TLT new lows here again, and on a closing basis also. I sold 2/3 of my TLT on Friday. I did not add back any today. I did not add back any today, but I still have that 1/3 of my position that I'm kind of just holding on to here for TLT. The dollar made its pivot low on Friday right into the ADMA and had a gap and go today for continuation. UUP ETF working its way towards $30. And then again, talking about the haves and have-nots in the market, it's like depending on what you're looking at. So SPYs, once again, finished flat on the day. The RSP is destroyed and Qs are higher. So it's like depending on what you're looking at, there might be some traders out there who was like, man, this was such a bullish day. Some of these stocks were just so strong. The things I focus on were so strong. And you could have another trader like, oh my God, what a bear market we're in. Like, things are getting absolutely destroyed. And I mean, you can just look at Apple's daily candle today versus the XLU daily candle today. And there you go. That's where the difference comes from. And it goes back to also a big theme that we've been talking about a lot for at least a month of dispersion, where here we are with the S&P pretty much exactly flat on the day, and I'm looking at the utility ETF on a day 5 to the downside, closing down 5% or so on the day. Yet Apple, which is obviously the largest market cap stock, I think, and is up 1.5% on the day, and closed back above a key level of 173.50. So, talk about dispersions. Certain things out there are getting destroyed, and certain things, particularly those cash-heavy companies, those Microsofts of the world, are holding in great. And who's right? Is it Bank of America? Is it Goldman on their call? I don't know. Maybe they're both right in certain ways. Maybe they're both wrong in certain ways. I guess time will tell. But it certainly made for an interesting trading session. In some ways, I thought that today was a very difficult trading session. We had a few great call outs. The Nvidia call out off the open was just such a layup of a trade. I didn't have it on my list this morning, but almost every morning in our morning meeting, I go through all these big cap tech stocks. Nvidia got upgraded this morning. It was going into 440. The only reason I didn't have more conviction on the 440 long in Nvidia was the market's technicals. The market technicals after Friday, if I can't type, there we go. Friday is a potential pivot high in the short-term downtrend in the market. And I don't necessarily want to be buying the second day after a potential pivot high at this point. It's different a couple days ago when the market's getting extremely oversold on the 27th and we have a high probability of a snapback and we're $10 extended on the SPYs to come in and go the other way. But Friday, when we gapped up to above the 80 MA and sold off and closed really weak, it's very difficult to predict that right here is where a lower high is going to come in the market. That's the beginning of a reversal pattern. I don't predict reversal patterns as kind of a rule. I predict periods where retracement can happen and retracement can turn into reversal. So what I'll always say is, let's just say, hypothetically, that today's low becomes an absolute low, and over the course of the next couple of days, we break above Friday's high, so we break above that potential pivot low. So that means our short-term downtrend is starting to break. We'll get back to 435 in the SPYs, which I think I identified as kind of target number 2 for a bounce. You're looking at a very small time frame daily chart reversal if that happens. You're going from a pattern of lower highs and lower lows to a low, a high, a higher low, and then a new high. That's now technically a small time frame uptrend. I'm pretty much never going to come in and predict this low. And this is a low, if it were to give follow through and break this high, that is a reversal pattern setup. It's always a lower probability trade. It's a very difficult risk reward to come in and do any significant buying on today's candle on a day 2. So that's why I came in today. I don't want to say I was necessarily outright bearish, but definitely not bullish, right? Because I recognize it's very hard to buy after this pivot. What I really need now, if I want to go long, is one of two things. I either need Friday's high to break, and then I'm having confirmation of that reversal, and now I can look to go long again, and I'm with trend. Or I need this pivot high to lead to a similar situation to what we had when I was last looking for longs, which is 2, 3, 4 down days where I'm now looking at $10 of extension from the 80 MA and us approaching a major support level, and I can look to get long again. But the idea on retracements becoming reversals is that even though I won't come in and nail the long side on a day like today, if this leads to a higher low that leads to a higher high and is a reversal pattern, I'll still have longs from the 27th because I implement a game plan of reward maximization where I recognize it's counter trend, so I want to sell a larger percentage of my position into that equilibrium area, but I am also keeping a small percentage just in case that retracement higher becomes a reversal, especially in conjunction with the daily chart, big picture, which is still uptrending. And when I'm looking at a small time frame downtrend within the confines of a large time frame uptrend, most of the time, not always, the large time frame uptrend wins. So I have an extra little layer of probability on my side that this market can reverse higher. And especially in my mind, now that we've gotten through that second half of September, which is seasonally weak, I also think we kind of need to get a little bit through this week where we could still see some further weakness. But then we come into earnings season and the market proves itself through earnings reports. And then we come into that November, December period of time, which, again, historically has the opposite in terms of seasonality and flow. And we'll see if that can lead to higher action. So I thought that today was a very difficult day. But if you focused on relative strength and relative weakness, especially if you didn't do what I did, which is buy relative weakness and thinking that I'm, buying extreme relative weakness into extension and I can get the snapback, it's just such a hard trade. And it's so easy to make mistakes on those trades, and I did make a mistake on that XLU today, which I'm happy to talk about. If you focused on buying relative strength, that NVIDIA was where it was at. I mean, we were able to see pretty quickly off the open that big cap tech was where the strength was. Someone mentioned, oh, NVIDIA's above 440. It typed it up, and it looked great. I remember it was trading at 440.04 when I typed it up, and I was like, wow, you could definitely be long this thing versus lows for a trade. I mean, just if you're willing to take the risk, because NVIDIA is an expensive name, you got to give it a lot of space. $1.40 plus worth of risk down to lows. The thing was a phenomenal trade. Easily can give $10 worth of upside. It's a $500 stock. It's NVIDIA. It did that in a really short period of time, topping out at like 452. I mean, just a great trade. And I was still able to make some money. I tend to probably overly focus on, for my own trading and my own communication in the virtual trading floor, and this is something I should do a better job of. I tend to overly focus on the things I'm kind of battling with, and not the things that I'm in that are just making me easy money. Like I'm long Apple, I'm making money in it, and I'm like okay, like I expect to be making money. So I'm not focused on this. Like, okay, Apple's making me money, great, I have a position, I have a game plan, I have offers, I just sold some, great. Microsoft is trading well, okay, great, I'm long, I got some stock, I got some offers out, I'm making some money, great. Amazon, week off the open, the first 5 minutes, but then turn around, it's working its way higher, I got some offers out, I'm booking some money, great. I'm on the other side, because these trades are so much harder, and I don't necessarily recommend them. Even though we had a great snapback in this XLE, I'll start with the trade that went really well for me before I talk about the trade I finished down on. XLE, we know that big picture on the daily chart, this is still a really strong area for the market. $89 is a big support level as well. It did get hit really hard the last couple of days, along with the IWM, and they are selling the heck out of this XLE off the open. On this 950 bar, it's just super extended. You're looking at, the fifth candle on the downside. It's 950, so, extension on the 5 minute after 20 minutes becomes rare. You usually start to see price and time corrections around this time. You get that hammer that comes in. I mean, we were even buying before that. Pat nailed the bottom. I started earlier than Pat did. I bought like real small, I think at like 88.76, and then I was getting a little bit more aggressive in the 50s, the 88.50s, especially when I saw Pat call out, because Pat is honestly much better at the counter trend stuff than I am, and I recommend, if you do want to trade counter trend, I'm decent at it, but Pat's much better than I, and it's a great combination, I think, when we're both looking at the same things together. So Pat calls out the XLE. He's like, all right, I'm going to start buying some now. I feel like it was like 51 cents when he said that. The low's 49. All I'm looking for on these trades, though, it's somewhat similar to what I was just describing with the daily chart on the SPY, right? All I'm looking for on these large levels of extension, I'm just doing it on different time frames, is a snapback to the equilibrium area. Counter trend trading is inherently reward limiting. With trend trading is not reward limiting. I don't know, reward maximizing. I don't know what the right term is there. So I create a game plan for myself when I'm buying stock, and it's like, all right, I'm just looking for a snapback to the ADMA on the 5 minute chart. I'm not even going to be greedy with this. I probably would have been more greedy with XLE and given some profit back. Again, similar to the game plan I was just talking about on the big picture with the SPYs, where it's like, here I've got this big extension. I might not capture the trade today if this becomes a higher low for the market that leads to a higher high that creates a reversal pattern, because this, to me, is a very difficult trade. If you're trying to make a long stand on the market today, you are saying, I think this is the bottom, and I think the market's going to reverse. And for me, I find that to be a lower probability, not good risk-reward trade. So it's a trade that I want to avoid. I want to still have the stock from here, which inherently means that I'm not selling all my stock on Friday when we actually get to the ADMA. XLE, though, the game plan that I'm creating for myself is to actually sell all my stock out at the ADMA. But I'm doing that specifically because I don't really want new long positions. I've already got a lot of Chevron exposure. I don't necessarily need new energy exposure. So for me, when I'm taking these day trades, I'm also thinking about my game plan that I'm creating within the confines of the portfolio that I'm in. If I was like 100% flat position-wise, and I took that XLE trade, I know Pat scalps a lot of these and he gets totally out, and that works for him. And again, he's probably better counter trend than I am, so definitely don't be afraid to follow along with his game plans and just take the money and run. But the way that I'm going to operate is I'm probably selling a large percentage of my position by the time it gets to the ADMA, an even larger percentage of my position by the time it gets to 21 EMA. But I'm going to keep a little bit just in case when this pullback comes. Again, think about the SPY chart right now. Overlay it in your brain on this XLE 5-minute chart. Instead of getting the pullback that breaks new lows and goes down to lows, you get a higher low that comes in at 88.90 that becomes a reversal pattern back through $89, which we know is a key level on the daily chart, and now you reversed back up on the 5-minute in XLE. I'm probably not going to buy that higher low most of the time unless I really got conviction on the daily chart. I'm not going to be adding there necessarily. But I'll like to hold stock just in case that retracement higher becomes a reversal, especially when the daily chart of the sector is still really strong and it's snapping back through a previous support level, and especially if I think that the market can support it, which obviously right now is a really big if. But instead, I had a less aggressive game plan of super extended. I'm going to create a game plan for myself where I'm going to liquidate my position entirely by the time the ADMA touches price action. That could happen in a number of ways. What I'm banking on and what I prefer is the actual price correction higher. The price correction is what is going to pay me. And this XLE is textbook picture perfect. Doji here, maybe not textbook picture perfect, because if it was, you'd have higher confirming volume. But outside of that, it's pretty much picture perfect. Doji comes in, you take your buy, you get the snapback to the ADMA, creates a lower high at the ADMA, and then continues down. But all you're looking for is a snapback to make money. So for myself, I liquidated my position at 89.34. The high of the move is 89.40. The ADMA is 89.41. I liquidated my position right in front of it. It was a good little chop, put a few dollars in my pocket. Nothing that's going to make my week necessarily, but I wasn't looking to make my week on the trade, just looking to make a few dollars. Now, at the same time as XLE is doing that, XLU is doing something similar. XLU is getting absolutely smoked on its 5-minute chart. Difference between XLU and XLE, though, is the daily chart. This daily chart's a massacre. It's a massacre. And on the one hand, and this is one thing that I still struggle with. It's a question I get sometimes is, Derek, what's better for a long? Something that is super, super extended because it's got more room to snap back just to get back to equilibrium, and that creates a better potential risk-reward, or something that has been relatively strong on the daily chart that doesn't have as much room for the snapback, but is relatively strong on the daily chart. So in the XLU, based on the daily chart, I've got more reward potential just to equilibrium. The XLE, based on the daily chart, I've got more reward potential because of the relative strength. Which one is better? I still don't know the answer to that. I think it really depends on the situation. In certain situations, it seems like the oversold one's better. In certain situations, it seems like the relative strength one is better. I don't really think I've seen anything that's uniform insofar as follow-through. So the daily chart picture is very different on these two names, obviously. XLU being really affected by TLT. People don't need to have money parked in XLU names for those dividends and that, dare I call it, safety of utility stocks. It's hard to call it safe when you can look at 5 days in a row of damage like this. But on the small time frame, I recognize that they're actually somewhat similar on that 5-minute chart intraday. And the XLE's got the relative strength, but the XLU's got the daily chart extension. So I would actually view the daily chart extension as a layer of probability that's on my side when I'm looking for it. I mean, without a doubt it is. It is a layer of probability that's on my side when I'm looking for the bounce on the small time frame, that there's extreme extension on the big time frame. Because at a certain point, I don't know when it's going to stop, and maybe there's continued mayhem in the treasury market and the interest rate market that leads to a further selling in XLU. Be careful catching a falling knife. Markets can remain irrational longer than you can remain solvent. Pick your favorite trader saying there. But I know that XLU cannot continue to sell like this forever, unless all of a sudden people are deciding that they don't need electricity anymore. So recognizing that extension on the daily chart I view as actually a layer of probability on my side when I'm looking to take these smaller time frame extension trades that is similar to what I'm looking for in the I lost my train of thought, but in the XLE on the 5-minute chart. So where I really made the mistake was at like 10:15. So I had bought a feeler already by that time, but what I kept doing was I have my feeler. I want to get size on the way up, right? I don't want to catch the falling knife. I want to buy these things on the way up, not on the way down. And I remember on a few occasions, 57 was one of those occasions. Like it broke 57, and I'm like, wow, like look at this extension on the 5-minute chart in conjunction with the extension on the daily chart. This is a third 5-minute bar in the row here at 10:10. We just broke $57. I like the idea of buying XLU with size back through $57 on the way up versus whatever the low is, and it doesn't happen. It just continues to sell, and then I'm like, all right. Now that we've just put in a low of 56.78. I don't really want to buy 57 because now I'm taking on 25 cents worth of risk. It's more risk than I want to take. I want to be able to buy back through 57 on like the stock breaks. It goes to 92 cents. It goes to 95 cents, 56.92, 56.95. And now I'm able to buy it back through $57 on the way up and have a lot of size for 5 or 7 cents risk on a thing that's super extended on the 5-minute chart, on the 15-minute chart, on the daily chart, on every time frame in the utility ETF. At the same time, when in the back of my brain, this is more of a thesis that's not being confirmed by the price action yet, I'm expecting TLT to stabilize at a certain point. And then I see like, all right, this thing went down to 78 cents. I didn't get my immediate snapback higher. My buy stops, I had buy stops at 57.01. They never triggered. And that's one of the benefits, by the way, guys, of making sure that you're buying on the way up, not on the way down, is sometimes when you're looking at a price and you say to yourself, wow, I think this is a good price, I'd like to buy some stock, but I don't want to catch a falling knife, I'm going to buy it on the way up, so I'll put a buy stop, a little bit above where it's trading, and the thing just keeps selling and selling and selling and selling and selling. And if you just instead said, you know what, I'm not going to buy on the way up, I'm just going to buy at 56.96 or whatever instead, and assume that it's going to snap back, and the thing continues to sell, which sometimes happens, you're saving yourself a world of pain. So like I always think that you want to buy, as a general rule, in the direction in which stocks are moving. Whether it's a stock that's uptrending and or it's exhibiting upside momentum, and you're buying it high to sell it higher, or even when you're trying to do some of this counter trend stuff, you're trying to, for lack of a better term, pick bottoms. I still want to do it on the way up. It just makes for much better execution and much higher probability of success. But at the same time, so all right, my buy stop at 57.01 never triggers. It puts in a low of 78 cents. I don't really want to risk 25 cents. But now I'm looking at, and this is a trade that I've done with a lot of success over the course of the last year, albeit not today, the 5-minute RDR, right? Where it's like, man, this thing is so extended every time frame. It's so extended in the 5-minute. Look at this 5-minute. So, heavy selling, one rest bar. And one rest bar like resets the clock, right? So, when you look at an RDR trade, or some of you guys call it a DOO, it's the same thing. It should never be this, like you're buying back through the first red bar. Maybe not even buying back through like the second red bar. Like it's bar 3, it's bar 4, it's bar 5 that you can take advantage of extension by buying on the way up back through the bar's previous low. We do that trade on the daily chart, or look for that trade on the daily chart all the time. And what I've done with some success more recently is do it on small time frames. So I'm like, all right, so off the open, we know that's where momentum comes in. So the rules don't necessarily apply in the same way. The first 15 minutes, that's especially when extended stocks can become more extended. So 1, 2, 3, 4, 6 red bars in a row. And this is starting to get to that time, by the way, where it's 9:50 where you actually should be getting your first 5-minute correction. This thing is so weak that it never happens. You get 1 bar of basically time correction with this hammer that may have suckered some people in, which was also not confirmed by the volume, and then it immediately is breaking lows. But this candle resets the clock. So it's not like I'm continuing bar 7, bar 8, bar 9, bar 10. This one, it's a positive candle, it resets the clock. Now I'm getting bar 1, bar 2, bar 3. I'm bar 4 now. Okay, bar 4, bar 5. But this is where I like that RDR trade, regardless of time frame, to be able to come into play. I also really like the time of day, 10:15. 10:15, this thing's extended on the 5-minute chart, let alone the 15-minute chart, and this is about the time of day where 15-minute charts typically, and again, typically is the key word, because we work in probabilities, typically does not mean always. This is where 15-minute charts and 15-minute corrections begin to happen a lot. So I say to myself, all right, I'm going to take size here now on a 5-minute RDR, and I'm going to look for, really still just looking for the 5-minute snapback. That's really all that I'm looking for. So I buy back through like this 87 cents. Stop loss is should be 77 cents. So it's 10 cents worth of risk. The ADMA on the 5-minute at that time is 57.35. So I'm looking at 10 cents worth of risk on this 5-minute chart for this counter trend trade for at least I would hope hope's a bad word in this game. 45 cents or so worth of reward. 10 cents worth of risk versus with 45 cents worth of reward. Then on top of that, I've got the big picture that's super extended. So maybe, just maybe, I get a great price correction like I had with the XLE, but it happens with the XLU here at this time of day. And then maybe in this one, I'll be a little bit more aggressive with a small percentage of my position just to see if that retracement higher that I'm looking for can actually become a reversal. That's the thought process going into the trade. And then this is where my mistakes started to come in. I didn't get a price correction, I got a time correction. I sold a very little bit of stock into this move. I think I sold 99s once or twice into this move. Not enough to cover my risk. I guess I could have covered my risk on that specific RDR trade there, but I didn't. I was just, I don't know. I was looking for more, and this is where I make mistakes personally, and this is why I'm happy to go over it. I tend to make mistakes on counter trend trades. I tend to make mistakes when, I can tell you this is when all the biggest mistakes I've ever made have come from, when I'm more reward focused than risk focused. I really feel confident that I'm going to be right. And because I feel confident that I'm going to be right, why do I have to pay attention to risk? Stupid. Hey, stupid. Talking to myself. Hey, stupid. You always have to pay attention to risk because you will always be wrong and trades will always fail. So I'm not getting the price gratification, price correction that I want. I'm getting this time correction. By the way, what is this time correction called? It's called a bear flag, right? The buyers came in because there was some supply here. Sellers never lifted. They just went sideways. A time correction is a bear flag. So now I'm like, man, well, here I am. And I remember thinking this when this thing ticked 57 again. Like an idiot, I had an offer at 57.01. What was this high? 57. What was this high? 57. What was this high? 57. And I remember looking at my offer. I had an offer at 01, 06, 07, 11, 12, 16 on the upside, because now I had real size because I got much heavier on that RDR. I remember thinking to myself, the game plan here is really that I was just looking for the 5-minute correction, and maybe similar to what I just described with XLE and with the SPY, maybe that correction becomes something more. It becomes a 5-minute reversal, which is a 15-minute correction, and a 15-minute correction becomes a 15-minute reversal. A 15-minute reversal can become a daily chart reversal. I'm thinking about that in conjunction with time of day. I'm like, all right, market's stabilizing here, XLU stabilizing a little bit. It's 10:35. 10:35. We got to get a 15-minute correction at this point. This is ridiculous. Especially look at that daily chart. It's obscenely extended for how XLU tends to trade. This is really, really extended. So I'm gonna look for, instead of just, so what my game plan really said I was supposed to do is, all right, I didn't get the price correction, I got the time correction. And I've described this in previous afternoon meetings. If my initial target's the ADMA of 35 cents, but that ADMA continues to go down, what I am supposed to do, and this is what I did actually in XLE, is I'm supposed to take an offer that I might have at 31 cents, and as the ADMA drops to 29 cents, I continue to stay in front of the ADMA. So, I'll trail the moving average, because nothing's perfect, by some cents, usually. And that's a random number, and I don't like random numbers, but I got no real other way to be able to do this. So, if the target's 35, and I'm offered 31, and now the ADMA is 29, I need to bring that offer down to 25. And then when the ADMA becomes 25, I need to bring that offer to 21. And then when the ADMA becomes 15, I need to bring that offer to 11. So what the time correction is doing is it's eroding my reward potential. But that's exactly what I want it to do. Like ideally I want XLE to happen and for it to just price correcting to go up. But you don't always get that. Markets correct through time and or price, right? Time and or price. When you're a counter trend trader, you're always looking for the price correction, right? And your targets, are those moving averages really because you're just looking for a retracement higher, and then those retracement higher should actually fail. Which is also, by the way, why you should just trade with the trend and not counter trend. It's just so much easier to just be with the trend. So time erodes reward when you're a counter trend trader. Time is not your friend when you're a counter trend trader. If you're a with trend trader, time is your friend. If you were just short this chart, I could talk about why. I mean, the reason why I would never short this chart is because of how extended XLU is on the daily chart, and that also goes counter to my rules. But let's just say you're short this chart. Time is your friend. You're like, oh man, this thing got really extended to the downside. Maybe I should be booking some profit on my short because of the extension. Oh, this is great. Look at this bear flag. It's going sideways. It's setting up for another leg. You don't even endure any pain of a price correction higher. Time is your friend if you're with the trend. If you are against the trend, time is your enemy. So every 5 minutes that go by, my reward profile here is dropping by 5-7 cents, something like that. And then eventually here on this bar at 10:35, that ADMA is at 57.05. And I remember being like, oh, I got this 57.01 offer, like whatever, but I wasn't bringing down all of my offers. I wasn't just hitting out. And the worst part of it all was I didn't really have a stop loss out for this. And it's a counter trend trade. And I remember, like, somewhere here, I was still on the radio. I don't remember if it was right before it failed or right after it failed, or I was just like repeating out loud, like follow the game plan, you idiot. Like talking to myself. Follow the game plan. Follow the game plan. Just follow the game plan. All you gotta do is follow the game plan. It's what I preach to you guys all the time. Follow the game plan. You create game plans for every trades, right? You want to be a consistently profitable trader. You need a consistent approach. The only way you can be consistent with your approach is if you have rules that enable you to be consistent. Those rules are manifested in the game plan. I created it's game plans that are based on rules that make me a consistently profitable trader. And then this is sometimes the hardest part, and it obviously was for me today, is then you have to have the discipline to be able to follow through with that game plan consistently over time. And I got a game plan that says, all right, I'm looking for the price correction, but a rule for every scenario. The rule for me for this trade, for the scenario of a time correction, even though I want a price correction, is that time erodes reward. I know eventually that this ADMA is going to get ticked. And I wanted to, the reason also why I wasn't using a stop loss, it was part of my game plan, was that I was willing to give this whatever room at this time of the day it needed, and I would have continued to add. I'm not necessarily recommending this for other people, I'm just telling you guys what I do. If you do this, it's very dangerous, and you got to make sure that you have an account that can afford it, because sometimes this can lead to really expensive trades. My game plan was to exit the position when the ADMA touches on the 5 minute. Whether that's through price correction, time correction, whatever, then I don't need to have a stop. Because I, in theory, should have been getting out of the position entirely between 10:35 and 10:40. Because I should have been bringing my offer down consistently 4 cents beneath the ADMA, and you can see very clearly at the high of the bar on this 1040 candle that, it touches. So I should be out of this position. I should be taking a loss in this position, really, because I bought like 87 on the way up, and I'm just liquidating. It's basically break even. I'm just going to liquidate the position at like 84, 85 cents because the ADMA has touched at that point, and that's technically my stop loss. And so someone tried to ask me a question about something counter trend that I was in. It might have been this XLU, and they were asking me kind of where my stop loss was, and my real answer would have been a very convoluted answer. So I don't think I answered the question this way. But the real answer was, I'm going to get out when the ADMA touches. But the ADMA was above it. And I remember some years ago when I was running the physical trading desk and had traders around me who were new, if anybody told me that their stop loss was above where the thing, like you're long and your stop loss on the trade is above where it's currently trading, it's like, wow, you must be like a bajillionaire if you could take every trade and have your stop loss be above where you entered the position, like automatically, even while it's still trading below it. And yet now I finally actually figured out a game plan for myself where technically my stop loss is above where it's trading and above my entry price, but it's moving based, it's kind of a moving target in that scenario, and it's based on how I define equilibrium and how I look at these moving averages. So that was really my mess up today, and it cost me. It cost me a lot of money because, again, based on the game plan, should be exiting the position 56.84. I would have been down like $300 in the name. Instead, I find myself, battling this thing on different time frames and really like stressing and studying the market on this thing, and finding myself down $5,000 at a certain point on the position, or might have even been more than that, instead of just following the game plan, being out for a $300 loss, and that was it. So then, and again, and I think this might answer your question, Brian, where I messed myself up was, at this time of the day, I adjusted my game plan and said, all right, you know what, it's 10:35, this thing's so extended, I'm changing my game plan to not be for the 5-minute correction, I'm going to just make it for the 15-minute correction, because I think I'm pretty confident that we're actually going to trade up here to the 15 based on how we're basing and how this thing is applying some upside pressure into this $57, into this ADMA and the time of the day, and probability dictates at this time of day we get 15-minute corrections. So instead of just following my game plan and liquidating off the ADMA, I'm going to liquidate off the ADMA on the 15-minute, which basically is always very close to the 21 EMA on the 5-minute chart. So that way, my reward that I was originally looking for is still there, right? At this time of the day where I should be exiting the position, the 21 EMA is at 57.61. So I actually still have great reward profile on that idea of the trade on the 15-minute chart, and the 15-minute correction has to happen eventually. But, and that could be a good game plan, actually. It could be a good game plan. It could be a game plan that I even consider using. But the problem was, and this is where I guess the real heart of the mistake comes in, I created a trade with a game plan based on a 5-minute chart. And I adjusted the trade to a 15-minute game plan after I'm already in the trade. And that's a violation of discipline. It's a violation of rules. What I always tell everyone all the time, buy the ticket, take the ride, right? If I was a genius, perfect, ultimate god of trading, I would liquidate every single position just as soon as, something changed. But I'm not that person, and no one is. You're not either. So instead, I can only go based on my rules. So that means that if I have rules on where I have a stop loss, rules for where I take reward, I follow it like to the death. That's what I'm supposed to do. But the problem of changing the game plan from a 5-minute chart to changing the game plan to a 15-minute chart, again, it would be fine if the game plan was based on the 15-minute chart from the beginning. It's just that it wasn't. And now my sizing is all messed up. Because the amount of size that I have is based off that 5-minute game plan. If I want to do this more of a 15-minute game plan, I'm going to have much less size there. I'm going to recognize that this thing could bleed out a little bit further. Before I get that 15-minute correction, I'm going to game plan to comfortably average down on the position. Not what I was doing, which was uncomfortably averaging down on the position on the way down. Had a couple, luckily the other trades that I took, if you will, were perfect, and that helped me a lot on the position. Like on this trade here at 11.10, I went long again. I think I called it out in the VTF. I bought it was in the third bar here. I bought like 15 cents or something like that, and I liquidated all of that new long stock by 52 cents. The high was 53. I had a big sale at 52. I stepped away from my computer to make lunch. And when I got back, it was here. And I was like, oh, another 5-minute RDR. We still haven't even seen the 15-minute yet, and it's 11:45. I think that the market maybe could stabilize a little bit also. So then I came in and I had another great long trade here at 11:45, and I liquidated most of that long here. So I was like having these like kind of good trades along the way that were like kind of saving my butt in a lot of ways and helped me mitigate this loss. And then I got this little bit of a rebound into the close. But even here at the end of the day, I'm sitting here with negative P&L, a couple $1,000s in the name, swinging it overnight, which was not what I was planning on doing to begin with. I very specifically told myself coming into this week, I'm not taking any new trades except for some small day trades, maybe for a little bit of cash flow here or there. I don't want any new long swings in my portfolio. But now at the end of the day, I'm in this uncomfortable situation of, well, I'm down a couple $1,000 in it, but it's well off lows, and I'm well off my lows. So I could still risk the money that I've made back. This is a lose-lose situation, by the way. This is also the opposite of what I preach. But it's like you were already down, I don't remember. I think it was down more than $5,000. I was probably down 7 or 8 at lows. I can risk my P&L back to that low to see if I can, make more back on the trade. Again, total backwards way of thinking. Total. What I talk about? I talk about risk money that you've already made in order to make more. Here I'm talking about risk money that you've made back to try to make back more. That's like a lose situation that I'm putting myself in. But at the same time, I have to trade the position based on where the position actually is at that moment. So now I'm asking myself in the close, like, what's the right thing to do here? What's the right thing to do? The wrong thing to do is be in this position to begin with, but I'm in it. So what's the right thing to do based on where I am now? I really, really, really don't want to lose like $7,000 or $8,000 in XLU on the week before. I'm like gonna go away, which will probably happen if this thing breaks lows again tomorrow. But stock's at 56, the ADMA is at 60. I'm looking back historically at some of the worst sell-offs that XLU has had. Had a couple nasty ones in the 2022 bear market, in the June period, and in the September-October period. Even in these very, very heavy sell-offs, this thing never really ever got more than $4 extended on the daily chart. It got more than $4 extended on the daily chart today. It's off lows. My P&L is off lows. I'm like, you know what? I'm just going to risk giving it back this 75 cents to see what else I can get out of this, potentially off this daily chart over the course of the next couple of days, and see what it's actually able to do on the upside. But again, I'm in a lose-lose situation. I just think that the right thing to do from this point, from where I currently am, is just to continue to manage the position. And I was able to sell some stock into the close, kind of on the way up here in the teens and in the 20s for the stock. I can rebuy that stock tomorrow if I need to, anywhere between $55.50 and $56 or so on a pullback, as long as it's still above that low. I still have enough stock here where I could very easily be back green. I could be green by the time I wake up tomorrow in this thing. Like with the amount of sizing that I have in this thing, I just need this thing to be at like 56.60 or so to be back at break even. But if I'm keeping it at this point, I can't trade to break even, which is another thing that a lot of traders do, and it's a huge mistake. It's a lose-lose situation. What am I doing here at this point? Well, I'm gonna risk losing $8,000 to try to get break even. Show me who's gonna be a successful trader here, who risks money to make zero. Yeah, no one. No one's got their hand raised, myself included. So I gotta try not to do that. Really at this point, if I'm keeping it, I almost need to be game plan based off the daily chart extension. I just also, and this is the whole reason why I didn't want to get myself in these positions to begin with. It's a little bit similar but different to what and I'm extra annoyed at myself because I don't make mistakes very often in my trading anymore. I think I have finally, after 13 years of doing this with T3, 15 years of doing this total, I finally gotten to the point here where I find that I'm making like one mistake a quarter, and that's pretty good, I think. It's still not where I want to be, because my mistakes are always very costly. But one mistake a quarter, like, fine. But I just made a mistake in Chewy, like, super recently, and now here I am, like, kind of almost making the same mistake that I just made in that in XLU, and to make the matters even worse, it's right as I'm about to go on a vacation, and I'm gonna keep positions while I'm away, and I'll manage those positions a little bit while I'm away. But like, what I can't let myself do for my own sanity is be like, yeah, I'm not going on the safari because I got to manage my XLU position. Like, I almost said a bad word to myself right there. But I can't, like, come on. So I might find myself in the terrible situation where I end up liquidating my position just entirely if I get back to break even and just moving on, just because I don't want to have the position and continue to manage it while I'm going away. Though that's not the right thing to do. The right thing to do is to never go on vacation, and at this point, the right thing to do for the position would really be to manage it based off the daily chart. Create a game plan for myself here where I can use today's low as a stop loss going forward, but if reward comes in, not just get out at 56.60 when my P&L is 0, but actually be game planned off that ADMA so that I can look for a price or time correction where maybe I get a move back to 57.50 would just be a good percentage of today's candle. If somehow over the course of the next couple of days today's candle can be negated, especially with the volume today, you'd be looking at like a king-queen reversal, reward profile $60-$61. Like that's really what I should be thinking if I'm keeping this position overnight. Is like, yeah, you made mistakes in it. You were down, $7,000-$8,000, whatever it was. How are you going to make that risk worth it on the reward side? And the only way to do that is to be game planned off of what I was kind of looking at to begin with, which is this daily chart, where I can still potentially make a multiple of the $7,000-$8,000 that I was down on the upside if this thing actually bounces and actually gives follow through. If it opens down $1 tomorrow, if it opens past my stop, I have rules in place for how I handle trades when they gap past my stop loss, which is basically what I call my 15-minute rule, which I've gone over in the past. My 15-minute rule on swing trades is that I don't use stop losses in the first 15 minutes of the day on swing trades, which is very rarely a problem. It's very rarely a problem because if you're swinging properly, you're always keeping positions with a profit cushion. So even if the stock gaps down tomorrow, if gaps down $1, like if XLU gaps down $1 tomorrow, but my price in it, because I'm like a great trader or something, was 55.60. Like how I should be swinging this position if I was swinging it is because my price is 55.60. Pat told me when to buy the bottom because he's way better at that than me. I got in at 56.50. It's closing at 55.60. It's closing at 56.20. I've got a 60-cent profit cushion on a $56 stock, and I'm looking for reward potential to $57.50, possibly even $60. And if it gaps down $1 to 55.20, it's gapping down 30 cents past my stop loss, and I'm still green in the name. That's the right way to swing trade. If it gaps down $1 tomorrow, I'm in a really shitty spot. I'm already down a couple $1,000 in it. If it gaps down $1 tomorrow, I'll be down significantly more. But the only thing I can do, because I've already put myself in the lose-lose situation as opposed to the win-win situation, is still follow the rules that I utilize when stocks gap past my stop loss. Normally, I'm much more comfortable. I'll be annoyed to give back profit. Again, say I'm long for 55.60, it's closing at 56.20, and it gaps down $1 on me, it gaps down 55.20, and now I'm 30 cents out of the money, and I'm closing out of the position because I booked some profit during the day today, which is tomorrow's yesterday. I gave back all my profit. I'm out. I made $10 in it. I gave back everything I made yesterday afternoon, and I'm annoyed. But guess what? Guess what annoyance looks like to me in that situation? It looks like a donut. I risked giving back profit. I gave back profit. I had the worst possible situation of a massive gap down past my stop loss, and it was worth it. It was worth it to have that donut because of the reward potential on the trade. Um, that's how it should be, and that enables me to implement this 15-minute rule. And the 15-minute rule has been a lifesaver on swing trades. Can't tell you how many times over the course of my career it's crazy how often this has worked. Where I've had a stock gap past my stop loss, create a low within the first 15 minutes, and then that have be an absolute bottom and never break that low. But that's what my 15-minute rule dictates. You gap past my stop loss, I don't hit out for 15 minutes, I wait. Whatever the low is after 15 minutes. And the reason why that rule works is because panic selling happens usually in the first 15 minutes. So if there's going to be panic selling that comes in because XLU gaps or whatever stock gaps past that important loss, the people that are going to freak out to like if XLU gaps down to 55.20 tomorrow, and I was long from 55.60, and now my P&L is 0, I'm annoyed. I'm not freaking out, right? But if the actual me, the situations I don't like to put myself in, where I'm down a couple $1,000 and now this thing gaps down $1, I'm gonna be like freaking out. I am disciplined enough to not hit out and freak out off of like actually let my mental freak out translating to me pressing the sell button, because I have a rule in place and I will follow the rule with discipline no matter how uncomfortable the rule is. And that's also where we mess up, right? We mess up because the rules that we created are uncomfortable. I don't want to take the loss. You know, I don't want to hold this position anymore because I can't handle looking at it go sideways anymore, and I think my trade's gonna fail. But like, I can't emphasize it enough. Like all you need to really do to be successful in this business, there's so many ways to trade. Create rules that are based on math principles of risk reward, regardless of what the strategy is, and then follow them, and you'll be a profitable trader. I wish Brant Hirsch was here. I don't think he is, because he's got a quote from his old boss, Mark Fisher, that he has said to me in the past, that Fisher has said to him about what it takes to be profitable in the business, and it's basically the same thing. It's just so simple. It's so simple, but we are all, myself included, and I've been working on this my entire career, and clearly I need to work on it further. We are all our biggest problem in trading. You know, I would never be in this situation to begin with if I didn't fail to be disciplined with my trade and my game plan. I would never be in this situation if I didn't try to change my game plan mid-trade. And, you know, here I am in a lose-lose situation that I gotta try to battle out of. So that's all that I've got. It was honestly not a bad day for, I think, the team and for a lot of the trades that got called out, as long as no one was battling XLU with me in the same way that I was. I mean, honestly, you could have battled XLU and made money in it, as long as you know, or had a reasonable loss, as long as you did what I'm talking about, which is follow your rules in your trading. I have to catch a train, and it's 10 after 10 to get back to New York City. I don't have a ton of time, but I haven't even looked up what the train schedule is. But I'm happy to try to bang through some questions. Use Boeing as an example. How is it 25 days down? Well, it's not. It had some reset days in there. It's just a really, really bad chart. But I would argue that this was really the first, like, you kind of had like day 1, day 2, and then like a rest day that kind of reset it. Day 1, 2, 3, 4, and then like a rest day that reset it. And then this was just the bear flag. This was totally resetting the chart, letting the time catch up. And then you broke down again. Day 1, day 2, day 3, day 4, day 5. Oof. Potential RDR here on day 6, which resets it, which fails. Again, this candle here, especially if it had volume confirmation, it did not have volume confirmation. especially if it has volume confirmation, has a greater than 50% probability of getting snapped back to these moving averages. But it's still probability. So you always have to manage your risk. And then that reset it. Day 1, day 2, day 3. This was also a rest day, which also kind of reset it. And then you had inside and down here. Like the problem with this Boeing, this is a little bit more similar to Chewy in some ways, which has finally started to turn around a little bit and is looking a little bit better. The problem with this Boeing is it's never accelerating its extension. It's like you almost want this to accelerate its extension and accelerate that volume to create a real extension bottom, or just to start to base. This thing is just atrociously weak. You need days like this to try it long, and then you need to stop yourself out as per the game plan of your trade, and not do in Boeing or Chewy or XLU, any of those names, what I'm describing I did in XLU, or what I've previously described that I did in that Chewy position on the way down, which I'm still battling on this thing. You know, so that's it. Stocks can have they can have 50 days down in a row if they want to. Sometimes it's a little mind-blowing, especially if they're looking at like Boeing or a utility company. But it can absolutely happen. So you have to pick your spots and put your stop losses in. Thoughts on the shop daily? I have half from last week. It's still green. Yeah, I would just stick with the trade. You know, you at this point, you got the retracement. Hopefully you booked profit in the retracement. Now, stock that you still have, you're looking for the reversal. You're looking for the higher low to come in that then breaks Friday's high. So you should be left with probably a little less than half, unless you're being super greedy. Half is a little bit aggressive, but I also don't remember exactly where you're in from. But sometimes I support aggressive. You know, as long as your risk is covered versus this low, you know, you're in a win-win. But these counter trend trades have such a high failure rate that I try to, if I get to move into this equilibrium, have more than 50% sold, have 25% left, 10% left, maybe 40% left if I'm being super aggressive, and then take it from there. It's this massive seller stepping down on ARCA in XLU right now, which is bizarre. 100,000 shares on the offer. I'm tempted to buy it. Someone's being forced to liquidate some big position here in the after hours when there's no liquidity. Can't be fun. From Brian, is it safe to say you kept adjusting the game plan after the initial trade to fit how the price was behaving? Yes, but that's exactly what you shouldn't do. So repeating Brian's question, this is a great question. Is it safe to say that you kept adjusting your game plan after the initial trade to fit how I felt in the moment price was behaving? Yes. And that's the wrong thing to do, because I'm not good enough, and neither is anyone else that I've ever met, to be able to do that with consistency, especially when you're already in the trade. Because when you're already in the trade, I don't care how good you are, you're not objective about the trade. So don't adjust the game plan. And either way, you don't think you're protecting yourself by raising your stop too early or by hitting out of the position because you're in the money on it. That you're not. You're limiting reward. And you know, don't add more risk because you think the price is behaving differently and you can hold it longer or give it more room or something like that. Because that scenario increases risk in a way that will lead to failure. The other scenario reduces reward in a way that will lead to failure. From Cody, I think that XLU trade was representation of every trader's internal struggle of being disciplined and sticking to your game plan. We can plan all we want, but actually following through is a whole other thing. Thanks for going through the trade. Yeah, no problem at all, Cody. I'm telling you, we're our own worst enemy. It's another reason also, I think, on why you want to focus on being with trend generally as traders. The counter trend trading is so... it's like what we want to do, I feel like, more naturally. It's like what you want to do. Like, oh, it's cheap, I want to come in and buy it. And the opposite's hard too. Like you look at You look at a stock at $53, now it's trading at 66, and you missed it at 53, and here's the trade setup at 66. That's a much better setup most of the time. You know, obviously situation dependent, extension dependent, but assuming that there's no extension there, you're better off buying something that went from 53 to 66 at 66 than you are buying something that went from 66 to 53 on the way down because you think it's extended. The better stuff, the easier stuff, the more forgiving stuff is really, it's really with the trend. It's where the better reward profile is. But our natural psychology, I think, dictates to us like the exact opposite. Oh, it's cheap. Oh, I can get a discount. Oh, I don't want to pay up for this price because I should have had it at this better price. Like, come on. It's just not how it works. It's not how it works in practice. If you're an investor, it's different. If you know, I'm confident that if you buy Disney at $80, you'll eventually be positive in the position. I can't tell you when, but I'm confident that you will eventually be positive in it. But that's, you know, and that's, you buy as an investor with cash, without leverage, without margin, and you average down with more cash that you make, and dollar cost average, like dollar cost averaging and investing is the best way to make money as an investor. Dollar cost averaging, aka averaging down, aka doubling down, is the best way to blow up an account as a trader. So they're very different things. From Brian, I get when you're going green overnight with a padded P&L and the 15-minute rule. In this situation, and what I was referring to with the dollar down question, mistake was made, so why not absorb the loss and prevent further heartache? Yeah, I mean, so that's the question that I'm asking myself into the close on a day like today. Like, and most of the time, this is what I do. If I make a mistake like this, I just liquidate the position in the close to prevent further heartache, to prevent having to find myself in a bad headspace tomorrow, and then tomorrow's a new day, and I take my $2,000 loss, and I should be happy it's not an $8,000 loss, and move on. One of the things I've also learned over the years is at a certain point you have to like trade the trade and trade the money, and I need to create a game plan for myself based on where I messed up, and now I need to create a new game plan for myself based on where I think that the trade is currently, and I see this extension on the daily chart, and I've decided I'm willing to risk that gap down situation or down to yesterday's low for the potential to be able to, you know, make further back on this loss based on what the daily chart is telling me as far as the extension goes. But most of the time, I don't even think the right thing to do is let it potentially risk gapping dollar against you, and then do I just hit out at that time or follow the 15-minute rule? One saves me on heartache. I can just save myself the struggle to begin with by just liquidating right now and not caring if it gaps up or gaps down tomorrow or whatever, and just taking it from there. But I'm going to manage it for another day or two here and see what happens. Alright, gang, there might be questions on YouTube. Alright, from Jerry C. here. Is the price action counter to your thesis on the stock? Well, the price action was counter to my thesis on the trade when I took it here. I would say no, though, right now. And again, on the surface of things, traders might look at this chart like, I almost should take a poll here in the VTF, but I don't have time. I'm curious, though. Like, the poll would be looking at XLU right now, $56. Looking at the chart, for everything else held equal, forget about the market for a second. Would you rather be long or short the stock here? I bet we get a decently mixed answer on it. Like, you have to. Flat's not an option. Flat's not an option. Would you rather be long or short? The trend following momentum traders out there are going to say short. and the people who understand extension will say long. I would argue that the best answer, and this is not an answer, this is not an option of an answer, is to not be in it at all. I think this is a really bad short right here. I don't think that the price action is conducive for a short in XLU right now, despite what this chart looks like straight down. Historically, $4 plus of extension in XLU, you don't get further downside. And this degree of extension with volume beginning to maximize, I would argue that there's a higher probability that this thing bounces from here than, like, I would argue there's a higher probability of seeing 57 before 55 for sure, based on extension plus volume maximization. Now, is there a higher probability of $5 higher, let's say $4 higher or $4 lower? Is there a higher probability of a move to 60 or a move to 51? Or 52, I guess? $4 higher, $4 lower? I would say 52. So, like, let me repeat that. I think there's a higher probability of seeing this thing at 57 before 55, but I think there's a higher probability of seeing this thing at 52 before you see it at 60. And that's just based on an understanding of trend and extension. The degree of extension dictates a bounce. The trend dictates a lower high that leads to a lower low. So if you want to be short, you want to be looking at shorting this thing at 57.50 on Wednesday or Thursday. That's where you want to be, like something like that. Obviously, we got to take it as it comes. I can't tell you exactly what this chart's going to look like in 3 days. But yeah, I think that's the answer to your question there, Jerry. Because again, it's a balance between trend, momentum, and extension. All right. I apologize if anybody asked any questions on YouTube. I really have to go catch a train, so I didn't log into the YouTube. But if you are in the YouTube, give me a thumbs up, and I am going to end the meeting there. Have a fantastic night, everybody. I'll see you all tomorrow.